So I'll start first with a recap on US bank results. And firstly, what I would say is that they were quite good. So coming into the quarter, consensus was looking for earnings per share growth of 15%, and actually came in north of 20%. And all of the large 6 US banks exceeded expectations. And so really what we saw here was a very strong trading environment, fixed income, equity trading, derivatives, all doing very well in this sort of volatile environment. But importantly, some of the key KPIs that I look at as well in terms of like loan growth, efficiency, other fee income businesses, those are pretty strong in aggregate as well. So in summary, I'd say that Q1 results from the US banks were actually quite good. So then, as we sort of think about the next year for US banks, there's a few factors to consider. I'd say number one, just right now, there is a lot of uncertainty in the world, geopolitical uncertainty in the Middle East, high oil prices. And one thing this is really doing is kind of putting a bit of a damper on corporate confidence. So as you think about the investment banking businesses of the US banks, what they're saying is, there's a large backlog of activity, but corporates aren't fully exacting on this opportunity yet. They're still waiting for a little bit more certainty, a bit more resolution. So, this business in the short term could be slightly tempered versus long-term averages. That said, there's a few reasons to be optimistic as well in the short term. Firstly, I would say that credit quality, despite some of the headlines that we get on private credit, is actually quite good. The consumer is in good shape. Corporations are in good shape. Everybody's paying their bills. So as you think about the credit quality risk for US banks, it seems kind of well measured and not too much to be concerned about right now. The other thing I would point out is that lending growth. So think about lending to corporations, small, medium-sized businesses. That's actually starting to pick up. So that's important because US banks generate a lot of their revenue from lending income as well. So that seems to be on a good trajectory. And then interest rates are kind of in a sweet spot whereby banks can still earn a good spread from high interest rates, but they're not prohibitive such that they're kind of contracting economic activity in the US and abroad. So all in, the short term, if you're running a US bank right now, the in aggregate looks pretty good. So as we think more longer term about the sector, this is where kind of our scenario work, our valuation considerations really come into play. And there's a few things that I consider here. Number one, I think there's a really good case to be made that for the sector in aggregate, returns on capital should be moving significantly higher over time. And why is this? Number one, I would just say that business mix is shifting. So banks are really reorienting more towards higher fee income businesses like wealth management, credit cards, certain areas of investment banking, payments, kind of all these areas that are kind of high growth and higher return for these companies. Number two would be capital. So in the US, we've gotten a lot more certainty now on the kind of end game of capital proposals. So this allows banks to just more, properly allocate their capital with more certainty. And I think over time, we'll just allow them to, do more buybacks, potentially higher dividends, and just have more of a, disciplined capital regime as it relates to running their businesses. And then the third one would be AI and technology. And we think here this is a big opportunity for banks to become more efficient, to sort of reorient their staff count, their processes, and really just sort of get more out of their resource base, and over time really just become much more efficient entities. So all this to say is when we do our medium-term scenarios, we think that there's a good chance that returns on capital in the future for the sector in aggregate could be much higher than they are today. And that's why we feel comfortable with current valuations on the sector.